Welcome. Thank you so much for coming to watch the video today. We are really excited to have you here.
Absolutely. Thanks for tuning in.
So before we get started, I want you to imagine a totally counterintuitive business scenario. Think about your own workplace or your own business for just a second. If your leadership team stood up tomorrow and said, we are intentionally going to drive away a noticeable percentage of our customers starting right now.
Absolute panic would set in.
Right? Absolute panic. In a world where every corporate headline, every quarterly earnings call, and, every business book just screams about growth and more growth, what happens when a massive global company deliberately decides to shrink a part of its audience?
Just to save its foundation.
Exactly. And that is exactly the situation we are looking at today. For this deep dive into the source material, we are analyzing the Domino's Pizza Enterprise Limited, or DPE, 2026 half-year results presentation.
It really is it's a fascinating pivot because it completely goes against the standard public market playbook.
It really does. So our mission today is to thoroughly unpack DPE's massive strategic reset. We are talking about a complete 180-degree pivot away from the heavy discounting strategies they used to rely on and shifting entirely toward prioritizing the profitability of their individual franchisees.
Right.
We are going to summarize the company's prepared presentation, look at those key financial results and strategic comments, and then we are going to dive into the Q&A session to analyze exactly how the market analysts reacted. Okay, let's unpack this.
Yeah, to really understand the magnitude of this, we have to look at the core theme that was delivered by Executive Chair Jack Cowan and Group CFO and COO George Sayod.
Right, their prepared presentation.
Exactly. The central thesis of their presentation was simple but totally radical. DPE is deliberately getting out of the discount business.
Which is huge for a fast food brand.
Massive. Historically, they, a lot of fast food giants, leaned really heavily on broad blanket discounting to drive volume. It was all about getting as many orders through the door as possible. But now, they are shifting to a margin-accretive operating model.
A margin-accretive model. Let's translate that for a second for anyone who isn't a financial analyst.
Sure.
That basically means they want every single pizza sold to actually add meaningful profit to the bottom line, rather than just keeping the ovens busy for the sake of it. Right?
That is exactly it. And the logic here is really profound. By stripping away those constant deep-cut vouchers, they know they're going to sacrifice highly price-driven customers.
The people who only show up when there's a coupon.
Right, the heavy users who only buy on a deal. DPE takes a known, calculated hit on top-line sales volume. But in exchange, they drastically boost the bottom line for their actual franchisees. It's this major shift from top-line vanity to bottom-line sanity.
And the numbers they shared in the presentation really back this up. Franchisee profitability is actually up 4.5% globally. That hits $103,000 per store on a rolling 12-month basis.
Which is the highest level of profitability they have seen in 3 years.
Right. And if you look at their Australia and New Zealand market, the ANZ region, profitability was up more than 10% in January alone compared to the prior year.
Yeah, and they actually proved this model before rolling it out everywhere. They did this massive trial over in Western Australia.
The WA trial?
Yes. Western Australia is somewhat geographically isolated, so it makes it this perfect sandbox for testing a massive operational shift without it bleeding into the rest of the national market immediately. In that trial, DPE replaced all their heavy, aggressive discounts with just standard, everyday pricing.
And what happened when they turned off that coupon tap? Because I have to imagine the phone stopped ringing quite as much.
They absolutely did. Predictably, it cost them, those heavy, price-driven users, order counts dropped. But the trial proved that the model works for the actual health of the business.
Because the ticket size improved?
Exactly.
Yeah.
The ticket size, which is the amount spent per order, and the margin per order significantly improved. It takes a lot of courage to watch transaction volumes drop and hold your nerve, knowing the underlying profit is healthier.
Especially while trading as a public company where every quarter is put under a microscope.
What's fascinating here is that DPE is accepting short-term pain for long-term foundational health. This is a really rare and highly disciplined move in public markets.
Because the market usually punishes any drop in sales.
Right. And if we look at the key financial results they highlighted for the half year, earnings before interest and taxes, or EBIT, came in at $101.5 million. That is up 1%.
Yeah, okay.
Net profit after tax, or NPAT, was $60.1 million, which is an increase of 2.2%.
But the network sales themselves did decline by 2.5%, which is exactly what spooked a lot of the casual observers.
Right, but as we just discussed, that 2.5% decline was a fully expected side effect of this strategic reset. It's like pruning a tree. You cut back the dead weight so the core can grow stronger.
That makes sense.
And because they are being much more disciplined, they are pulling back on reckless new store openings and tightening their digital investments. That means their free cash flow vastly improved.
It jumped up to $70.6 million.
Yes. And because they had that cash, they were able to reduce their total debt by a staggering $196.1 million.
Slashing nearly $200 million in debt in this high interest rate environment is a massive win.
It really is.
And it seems they're making equally massive internal cultural changes to support this new financial reality. They announced that out of a $60 to $70 million cost-saving target, $55 million has already been actioned.
Mostly relating to corporate efficiency. Reductions in headcount, especially in IT, procurement, and logistics.
Right, and they have completely restructured the leadership team to execute this. The most notable strategic move here is the incoming group CEO, Andrew Gregory.
Yeah, he is a 30-year veteran at McDonald's. He has massive international franchise experience. He understands exactly how unit economics dictate the survival of a global brand.
The strategic comments throughout the presentation really focused on building a simpler business model, strengthening the balance sheet, and ensuring that any future growth is completely returns-led. No more growth just for the sake of having more dots on a map.
Exactly.
So that perfectly sets the stage. They laid out this bold new vision, they pruned the tree, and they told the market they are walking away from empty sales. Now let's transition into the Q&A session because this is where the analysts really got to grill the executives.
This is where it gets really interesting.
Yes. We are going to go through these questions one by one. Let's look at the major themes, starting with the sheer anxiety around this pivot.
Right.
So the first analyst question we're looking at is from Sean Cousins. Now, Sean asked for clarification on whether DPE will simply meet or actually exceed consensus for their full-year NPAT guidance. And he also questioned the impact of the WA trial on DPE's corporate warehouse earnings.
That is a really sharp question because it highlights the friction between the franchisor's revenue and the franchisee's profit.
Right, because if fewer pizzas are sold, the corporate warehouses sell less cheese and dough to the franchisees.
Exactly. George Sayud's response was very transparent. First, he stated that they aim to actually beat consensus for the full year.
Okay, that's bold.
Very bold.
Mm-hmm.
But regarding the WA trial and warehouse earnings, George admitted that yes, DPE takes a short-term hit on warehouse volumes. When order counts drop, corporate makes less money selling raw ingredients to the stores.
But the trade-off is worth it.
Yes, because the long-term benefit is a healthier, self-sustaining franchise network. If the franchisees are highly profitable, they don't need financial bailouts from corporate, and they eventually open more stores.
Which increases returns to DPE shareholders in the long run.
Precisely.
All right, moving on to the next question. This is from Michael Simotis. He noted that the market is essentially spooked by the softening sales and asked if they will deteriorate further. He also asked about the dynamic with the U.S. parent company, DPZ.
The executives didn't flinch at this at all. Jack Cowan responded by stating that sales will recover over the next 12 months, but they will recover the right way.
Meaning profitable promotions instead of blanket discounts.
Right. They are reintroducing sensible, profitable promotions. Cowan noted that the sales decline has already started to flatline, which indicates they've hit the bottom of that pruning process.
And what about the U.S. parent company? I imagine they might be breathing down their necks.
You'd think so, but Jack Cowan stated that DPZ is actually highly supportive. They went through a very similar, painful reset themselves in the U.S. market years ago.
Oh, wow.
Yeah, they had to fix their pricing and repair their franchise unit economics. And that exact playbook is what took the U.S. parent share price from about $3 to over $400 over a decade.
That is a phenomenal historical parallel. It proves the model works.
It does.
Next up, we had Craig Wolford from MST. Craig asked for a breakdown of the cost savings timeline, and he specifically queried a sharp 12% drop in marketing expenses.
Yeah, Craig really wanted to dig into that $60 to $70 million cost-saving target. George Sayud explained the nuances of how these savings hit the books.
How does that work?
Well, the IT savings are capitalized over time, meaning they take that upfront financial benefit and spread it out on paper over the next few years as depreciation.
Okay.
But the savings they found in food and procurement hit the profit and loss statement, the P&L, immediately.
So that puts cash directly into the pockets of the franchisees today.
Exactly right. And as for the 12% drop in marketing, George clarified that it relates to a reduction in the total number of stores, but also to managing a large deficit from the prior year's marketing fund. They basically had to tighten the belt to get the fund back to neutral.
So it's a normalization, not a permanent starvation of the marketing budget.
Correct.
Okay, this next one is my absolute favorite moment from the Q&A analyst. Sam Teague from Cydia asked a huge question.
The elephant in the room.
Yes. Sam asked how the rise of GLP-1 weight loss drugs like Ozempic is affecting Domino's. He also asked if the WA trial's success could actually be replicated in the tougher East Coast markets.
It is the defining question for the food industry right now. DPE's response was fascinating. They stated they haven't seen any material impact from weight loss drugs.
None at all.
None. And they pointed to strong U.S. sales data to back that up, since the U.S. has the highest adoption rates of these drugs. Pizza is generally viewed as a shared, indulgent occasion. Even people on appetite suppressants still participate in communal meals.
That makes total sense. And what about the East Coast replication?
Jack Cowan noted that Victoria, which is a very tough East Coast market, is already seeing substantial profit increases from the new pricing model, so the success is replicating.
That is great data for them to have.
Absolutely.
Moving on, we have Ben Gilbert from Jarden. Ben asked about potential M&A, meaning mergers and acquisitions. He wanted to know if DPE would sell off struggling regions like Japan or France. And he also asked whether the new incoming CEO might just abandon this reset strategy entirely.
Jack was remarkably candid here. He stated that they would consider selling a region if it proved to be in a long-term best interest of the business.
No corporate PR spin there.
None.
Yeah.
But he stressed that the primary goal right now is fixing the unit economics first. You don't sell a house when the roof is caving in, you fix it first.
And what about the new CEO?
Jack expressed total confidence. He said Andrew Gregory's deep 30-year experience means he understands this return-led strategy completely. He isn't going to make a bad decision to return to unprofitable discounting.
Which is reassuring for the market. Now, zooming out geographically, we had two analysts, AJ Mariswamy from Macquarie and Tom Kurith from Barrenjoey. They both focused heavily on international operations. They asked about selling corporate stores in Malaysia and the lack of profitability improvement in Japan and France.
George Seud provided some vital context for these regions. For Malaysia, he explained, they're successfully recycling capital by selling corporate stores to franchisees without losing DPE profit.
Okay, so Malaysia is functioning well. What about Japan?
Japan is more complex. During COVID, the demand for delivery exploded, and they rapidly increased their store counts. The business just became overly complex. It now needs serious simplification.
And France?
France requires better alignment. George explained they need tighter alignment between the corporate digital marketing strategies and the actual franchisees on the ground trying to execute them.
That makes a lot of sense. If the local operators aren't on board, the system breaks. Finally, to wrap up the Q&A, we had some chat questions read by Nathan Schultz on behalf of a few other analysts. They asked about DPE's target of opening 20 to 40 new stores. Specifically, they wanted to know what the financial benchmark is that is required to spur that growth.
And the response from Jack and George was very clear. The benchmark remains $130,000 in average franchise profitability.
That's the magic number.
Yes. That level of profit justifies the construction costs of new stores. Until the network consistently hits that number, they won't force massive new store growth.
So they are staying highly disciplined.
Very disciplined.
All right, so that covers the presentation and the massive Q&A session. Let's provide a high-level wrap-up of the main themes we've seen today.
I think the biggest theme is that DPE has undergone a massive philosophical shift. They are shifting from a growth-at-any-cost mindset to a strictly returns-led portfolio.
Right. They are explicitly refusing to give the shop away just to pad their top-line sales numbers.
Exactly. They are accepting the reality of lower transaction volumes because those lost transactions were margin dilutive.
And for you listening, whether you are running a massive global corporation or a small side hustle, there is a vital lesson here about the extreme danger of discounting.
Chasing cheap volume can absolutely destroy your margins.
It really can. It exhausts your operators and trains your customers to only be loyal to the coupon. Sometimes you literally have to shrink your audience to save your business.
If we connect this to the bigger picture, This shows the massive tension between impatient public markets that demand constant sales growth and the actual operational reality of running a sustainable franchise network.
BPE shows the long-term operational reality over the short-term market applause.
They absolutely did.
I thank you so much for coming to watch the video today. If you enjoyed this deep dive into the source material, please click like, share the video, subscribe to the channel, and stay tuned for upcoming content.
Yes, please do. And we want to leave you with one final provocative thought to mull over.
What's
If Domino's successfully proves that walking away from heavy users and endless vouchers leads to better long-term health, will this force a massive reckoning across the entire fast food industry?
an industry that is currently addicted to value meals and discount wars?
Exactly. If this works, it could rewrite the playbook for quick service restaurants globally.
That is an incredible thought to end on. Keep questioning the numbers, and we will see you next time.